This conference will now be recorded.
I'd like to welcome along to session 8 of the webinars for the Management Accounting and Applied Finance module. Tonight's coverage will be a little bit of a closeout to our session 7 material where we're looking at unit 12, and then we'll jump across for the balance of the night to our session 8 material, which is our units 13, 14 and 15. If we can just go back into the coverage with respect to our unit 12, however, you may remember that we looked at the coverage with respect to our cost of equity, weighted average cost of capital, at the end of the prior session. Within that pack, I've also got the capital budgeting area where we look at the methodologies of net present value, internal rate of return, payback period, and accounting rate of return. The 117 question was a smaller 5-mark question around determining which would be the most appropriate to apply in a particular instance. So in overall terms, it's probably the payback and the net present value that you're going to have a greater likelihood of seeing as you work your way through the process. But that question was a 5-mark question where you're getting to consider it across the board in total. You'll find there's also some coverage with respect to sensitivity analysis, where you look at that logic of adjusting variables, and activity 12.5 shows you that. And we also need to just pick up on our behavioural and qualitative issues. Qualitative relating to issues that would be considered in accepting and rejecting, behavioural relating to factors impacting upon the numbers utilised, and you'll find there was a smaller 2-mark question of that form back in the 313 exam. As we look to then go into the direct coverage, you've then got the logic coming through of your net present value. Now, I'd like to think that you understand that it's based on discounted cash flows. So the key is understanding the determination of the cash flows, consider the tax implications, and the base decision rule is that you accept if you have a positive NPV, you reject if you have a negative. Now, what I find quite curious through here is that you've got activity 12.3, 12.4, 12.5, worked example 12.1. So lots of practical questions in terms of you calculating NPV. The 117 and 317, however, have both been 8-mark questions, which arguably have been a touch more of a qualitative nature. So there's an awful lot through here, which is calculation based. I've always been surprised of late the little calculation the Institute has done in this area. Now, part of the reason for that, I believe, is because they're doing the calculations in Unit 13 for business valuations, where you're also seeing discounted cash flows in play. But I do just find it curious that we haven't seen a decent net present value calculation for a while. With respect to those activities, however, can you just make sure you pay attention to, I think it's the activity 12.4, which is the error question. So where they give you an NPV calculation, and then you've got to find errors in the calculation, and what would happen to your NPV if you correct it. So I like candidates, whilst all the activities in the worked example are quite good in this area, that activity is just something a little bit different as you work your way through. Now, you'll note that I said you did have to have an understanding of the determination of the cash flows. What I mean by that is that understand a little bit like your logic of your make versus buy in that. There will be relevant and irrelevant information. So excess information may be presented. And I appreciate the Institute keeps arguing that they're not trying to mislead. What they will do, however, is give you information that they would expect you to be able to look at and go, well, that's relevant to this decision. This isn't. As you then build, you've got the logic coming through with respect to your cash inflows. You've got the logic coming through with your cash outflows. So your cash inflows being where you're looking to include the increase in revenue and cost savings. Your cash outflows basically being including the initial cost of the project. Probably the key here is to understand your timing. Understand that basically year 0 is day 1. So that would typically be your cash outflow for the cost of the project. So day 1, year 0 is typically your cost of the project. Year 1 is then anything else that happens in that first 365 days. Now, again, that's where it's going to come down to how are you reading the cash flows as to are you dropping them year 0, are you dropping them year 1? I'd only go year 0 if it's cost or if it's in advance. The rest I would go with year 1, then drop it into year 2 and through. As for the style of question, we come back again, a potential calculate NPV. As I've said, I've been surprised by the lack of calculate NPV questions. You've got the logic of determining an annual savings figure, whereby they've given you an NPV and then you work out that it's a negative NPV. to take on this project, you would have to achieve these savings. And then I've already noted the identify error question, which is your activity 12.4. I do like that identify error question. I'm looking at this going, I've already said that there's been a move by the Institute more to qualitative than to quantitative. That error question is something I might see. From a formatting perspective, however, I trust that you're comfortable that with respect to this area, the Institute does everything via worksheet. So you'll bring through your initial cash outflow, so the purchase of the plant and equipment, something of that sort of nature, and it will come into year zero. You'll then have your different cash inflows and cash outflows, and they will drop into different year requirements. As you work your way through, you'll total those off, get your net cash flow. You are just going to pay attention in the exam whether they've told you to ignore tax or not. I'm including tax in my scenario as we work our way through. You've then just got to watch the timing of that tax. Sometimes I'll tell you that it's delayed. Sometimes I'll tell you that it's in the year of. The tax depreciation shield in turn, appreciate that as you read through the Institute material, they do make the point that you do not get depreciation taken into a net present value calc because it's not a cash flow. The only thing is the tax saving is a cash flow. So the tax saving limits the amount of tax that you're doing. So you may find that above or below the line. You then get an after-tax cash flow, apply your discount rate, apply your net cash flows. Now, it's probably easier to see that practically. So if I can just show you a brief example here, I've got the juice company, highly successful company built on the back of selling bottled juices. They're looking at launching these pop-up juice bars, and they've given you information around the cost of the kiosk, installation cost, average price per juice bar product. Total average cost is $2.10 per unit. Sales will total 20,000 units in the first year and grow by 10% per annum. Estimated life of the juice bar is 3 years. Decommissioning costs are estimated at $10,000. The juice company has a cost of capital of 10% and a tax rate of 25%. Now, basically what this would tell me is that those numbers there are going to be your year zero numbers. Your sales and your costs that you are being told about through this area here will be your year 1 through 3 number. So as I just briefly construct, note how I've got the logic coming through of my cost and my installation costs. You'll find that my sales are based initially at the 20,000 by the $4.50. So 20,000 by the $4.50. But then I've got my 10% increase each year. My costs would be the 20,000 by the $2.10. Again, I've got my increase 10% each year. Bring it down to my net cash flows. Sales less average costs would give me a taxable income amount. So I just take 25%. So note my tax rate is 25%. But then I've got to apply my tax depreciation shield. If you're looking at that tax depreciation shield, how is the $7,500 being calculated? Just take your cost and your installation of your 90. Keep in mind, they've told you you've got an effective life of 3 years. So that's 30,000 per year. We're then saying that our tax rate is 25%. So 30 at 25% gives us our 7.5. Take that 12,000 away, add the 7.5. You've got your cash flows. You've then just got to go to your discount rate tables. 10% at 0 year is 1. Year 1 is 0.909. Year 2 is 0.826. Just multiply through, add together. You get a positive NPV. So in this case, you would accept the project. And again, that is probably something that I am surprised that the Institute hasn't been doing. I understand why they're not doing it, because they've got their focus on Unit 13, but I would always suggest you being able to walk into a version of that kind and say, yes, you would accept, yes, you would reject, is something I might look to consider. The other path, however, is to give you that information, give you the NPV, and then have you find the errors. So for those joining me for the one-day course, you'll find we're going to try to find time to do that error question as we move through the day. As we jump out of our NPV, however, you've got your internal rate of return. Admittedly, you do see it in activity 12.5. It's not a major area for the exam. Internal rate of return is basically the discount rate, where the NPV equals 0. The decision rule is that you would accept the project if the internal rate of return is greater than your weighted average cost of capital. but maybe just from a relationship perspective, understand that if you have a positive NPV, then the internal rate of return is greater than your weighted average cost of capital. If you have a negative NPV, your internal rate of return is less than your weighted average cost of capital, which sits. Negative NPV, you wouldn't accept the project. So therefore, in that instance, if you've got a negative NPV, that means your internal rate of return is less than your WACC. And again, you would not accept the project on that basis. Do I expect that you're going to be doing calculations in this area? Well, it is noted that there is a trial and error method and a formula method. I would suggest that it's more likely the institute will give you the internal rate of return and ask you to do something with it. But I might also just note that as you work your way through, they do cover off some limitations. And that may be just something to note across all those areas. Just pick up on those areas and the advantages and limitations of each. In this area, one of the limitations is that if you have what we refer to as reversing cash flows, so a reversing cash flow is basically the logic coming through with respect to the fact that you'll have a cash outflow, a year or two of cash inflows, a year or two of cash outflows, that sort of process. That may actually create multiple internal rates of return. So that's when the decision rule becomes a little bit mixed, if you like. So that may be just something to be aware of. Once you've moved past internal rate of return, you come to the payback period. This probably has a little bit more of a chance, I would argue, in the exam. Yes, again, we've got an 8-mark question, which is that 117 question that I've said. We've also seen you do a smaller 4-mark question in Management 113. Now, it's probably that smaller 4-mark that I might expect that you will see as you work through. Activity 12.3 has both that NPV and payback requirement. 12.5, when you look at it, just covers everything. It looks at NPV, internal rate of return, payback and through. But activity 12.3 and 12.5, more than enough practice in this area, in my opinion. Basically, your payback period is a period it takes for forecasted cash flows to return the initial investment. The decision rule is which one pays it back the quickest. If you're only looking at a single project, what is your pro forma period? Got to be paid back within 4. This project's paying back it within 3.5, so therefore we would accept. You would calculate using either the formula or a table. Again, understand advantages and disadvantages, and maybe just have an appreciation that one of the criticisms of payback is that it doesn't take account of the time value of money. The way you get around that is to perform a discounted payback. Now, if you're wondering what I mean by the formula or table, quite simply, you'll find formula where you have the same annual cash flow year on year. So same cash flow year on year, take your initial outlay, divide it through by your average annual cash flow. If we're looking at, however, and you've got alternate cash flows, then you would do the table basis. Now, what I want to show you tonight is that process. So I'm using simplistically the same set of facts that I showed you before. You've got your cost of the equipment at 75, installation cost at 15, you've got your sales, etc. So same information as before. What that means is that we still need to construct our base numbers. So we still need to construct, well, okay, year 0, we've got the outflow of the 90. Year 1, same logic, 20 by $4.50, 20 by $2.10, get you your 90 and your 42 to give you 48. What I'm trying to highlight, however, if you're looking at this then from a payback perspective, what you're seeing is how long it takes you to pay back the 90,000 investment. So you'll find the institute runs a little table of this form where do your initial investment at 90, year 1, net cash inflow of 48, investment recouped is 48, unrecovered initial investment 42. So 90 less 48 leaves you with the 42. Come through with respect to the second year, net cash inflow 52.8, investment recouped 42. Note my answer of 7.95 is basically the 42,000 divided through by the 52,800. That gets you your 0.795. So that would get you your 1.795 is how you would think it through. But again, just an appreciation of how they could do that for a smaller mark question. And then the other one, which I doubt that you'll see, is your accounting rate of return. Basically what you're looking at here is the decision rule is where your accounting rate of return is greater than your WACC. Make sure that you just do a little bit of engagement with the idea of the formulas, which you see in activity 12.5. I think the chance of you seeing accounting rate of return is probably minimal based on the lack of interest in this area of late. So therefore, to round out, and before I jump across to tonight's coverage, behavioural influences, these are fundamentally the factors that will impact upon the construction of numbers. So you've got predicting of inputs. Naturally enough, determining inputs for future years can be subjective. Pet projects, personally or emotionally involved. So you may be attached to this project. So you will create numbers that make the project look attractive. Ritual, so automatic without analysis, and that in the real world is one of the major criticisms at the moment, that this process is just being undertaken without any real look at whether the number's appropriate. And then you've got the logic of risk seeking and risk adverse, which is where you'd come back to this idea that risk profile, as you saw back in Unit 2, different parties would have different risk profiles. So someone may see a negative NPV and still take on the project because they're risk seeking. Someone might see a positive NPV and reject because they're risk adverse. So again, just behavioural influences to have an awareness of based on what's in the Institute's material. But just wanted to do that closeout with respect to that coverage. Again, interestingly, they're focused on Unit 12 of late more across the cost of equity, weighted average cost of capital area. You won't find a lot of past questions on the net present value, payback coverage. I just suspect it will come at some stage. I'm not necessarily saying it's got to be this time, but I am surprised by the lack of examination. As we build through this session material coverage, however, you'll understand why that is probably occurring. Because this session coverage of Session 8 is built across Unit 13, 14, and 15. Certainly Unit 13 is your coverage with respect to your business valuations, where they take you through you understanding the overview of the different types of valuations and the purpose, the methodology, so what are the different types, you compare and contrast and you understand their application, and then you understand the other impacts, so factors that influence the valuation that you're putting in play. Now, as you consider the logic of the type and purpose, what I'm going to bring to your attention is that as you engage with this material, you'll find the Institute's very big on the logic of the table format. So they take you, I think it's Candidate Study Guide around page 13.5. I may have that page numbering out slightly, but somewhere around 13.5, they talk about the different situation events include that you're looking to acquire a business, divest of a business, undertake an IPO, and they give you a few others. Of course, the reason why you acquire a business is so that you grow the business. The reason why you divest is to release cash. With respect to an IPO, you're looking at establishing your price expectations. They then observe that with respect to the valuation, however, it may be enterprise or equity based. So enterprise, it's the value of the business as a whole. Equity, it's the value of equity only. Simplistically, enterprise value is your equity value plus your market value of debt. So as I said, they do a little bit of coverage initially around some of the base groundwork here. I'm not necessarily thinking that's going to be a major exam point, but I will just observe this in particular around the acquiring the business, divesting of a business would link back to your Unit 1 and your strategic alternative coverage. So I suppose they could build that you're looking to acquire, maybe give consideration to factors that you would look at from a valuation perspective in acquiring that business, maybe how they pose it. Once you extend from that, you then come through to your methodology. So with respect to your methodologies, you will find that there are 3 methodologies which you are presented. I'm going to argue the 2 primary ones for you are your income-based and your market-based. Cost-based Institute doesn't do a lot on. I would also note, however, that Management 218 question 4 Part A was a smaller 4-mark question, which had you working your way explaining the logic of and understanding the different types and whether adjustments had to be made to those different types. So client had come to you, we've got our income-based, market-based, cost-based. We don't understand under the income-based why this is taken into account, and you had to qualitatively explain to them. You'll also find, however, as you engage with the Candidate Study Guide, page 13-7, that they look at it from a strength and weakness and applicability perspective. And I would probably, just for that smaller mark question, be able to identify if I'm under pressure in an exam, either through the quick reference or through the Candidate Study Guide, what the basic strengths and weaknesses when you would apply. So by way of logic, Note, income-based value is determined by forecasting and then discounting. They talk about from an applicability perspective, it's the core technique used for valuing both business acquisitions and disposals. Market-based value is determined by benchmarking it against the value of comparable quoted organisations. It's used extensively by the investment community to compare and contrast relative values. Cost-based value is determined by collating the cost of all of the assets on the balance sheet, then adjusting the replacement or liquidation value, often carried out to obtain a preliminary view. Now, I've already said cost-based isn't likely for you. Income-based and market-based is where the Institute are predominantly, and even then, it's probably a little bit more weighted towards the income-based area. So if we were to dig in to these in a little bit more detail, with respect to your income-based, now, again, note how I've already said tonight that we're not seeing a lot of NPV questions, discounted cash flow questions, because we're seeing it coming out of Unit 13. Guys, income-based is basically based on discounted cash flows. And as you'll see in a moment, there's been a continuous examination of this area. So it's not that they don't want you to be able to understand cash flows. It's just the unit coverage that they're examining it in. Basically, your cash flows will either be your free cash flow, so cash flows available for distribution to all providers of finance, or cash flow to equity, so your free cash flow less your interest payments. You'll find that there are two approaches identified, enterprise and equity, and I'm going to be a strong believer in the fact that as I sit in an exam environment, I'm going to pay attention to which one they are asking for. Have they asked me for the enterprise? Have they asked me for the equity approach? So basically with the equity approach, you take your free cash flow and you discount it using your weighted average cost of capital. So your free cash flow, discount it using your weighted average cost of capital gives you an enterprise value. Take away market value of debt gives you an equity value. So note the ease. If they've just asked you for enterprise, you'll work your way through the worksheet, which I'll show you in a moment, discount it, get you your enterprise. If they've asked for enterprise and equity, once you've got the enterprise, take away the debt, that will give you your equity. The other approach is to do equity directly, where you discount cash flows to equity using cost of equity. So you pick up your cash flows to equity, discount using your cost of equity to arrive at an equity value. Cash flow to equity, however, from an exam perspective, isn't as easy to interpret. So therefore, that's why we're tending to see the Institute take the enterprise approach and then step it through from there. I'd also suggest, however, as you explore this, note the Institute with respect to the enterprise value, show it to you in activity 13.2 and worked example 13.1. We've then seen the enterprise value path come through in 119, 218, 317, 216. Contrast that to equity, where realistically it builds from your activity and your worked example, but you'll find the last couple of exams have been more enterprise based. Now, I would also note, however, as you consider those, 6 marks, 8 marks, 12 marks, 14 marks. So we've had reasonably consistent examination here. The only exam that hasn't is probably the 117 exam. And we're getting, mind you, the marks have come off a little bit, but still reasonable marks in this sort of area as a first point. And that 317 and 216 basically just crossed over between the two. Now, of course, this all comes back to your ability to calculate your free cash flows. Basically, it's a cash flow available to pay returns to both debt and equity providers. There's a base calculation where we need to engage with a worksheet or a table. We also need to ensure that we're adding on our terminal value, and we just need to watch the multi-year implication logic, as I'll explain. I would also highlight, however, curiously, what the Institute has done this time is in 319, they have added coverage with respect to estimating free cash flow. Now, I personally believe this should have been here all the time. But for the first time, the Institute have turned around and gone, oh, but of course, if you're looking at acquiring an entity, you'd take their, at a base level, their earnings, but then you'd have to consider, do they need adjustment? Are there related party transactions? Are there non-recurring or non-operating income? Are there extraordinary items? So I'm actually looking at this and thinking, you know, if they come back here again, they may actually pose it in the sense of, well, here's our base earnings from this set of background facts. what adjustments do you believe need to be undertaken to get our earnings figure to use in our free cash flow determination? Now, again, I make the point, new for 319. So therefore, it's just intriguing for me that for all the time this should have been in here that it hasn't, will they bring that area back into play? If we go back to more of the style they've been doing, however, guys, basically they're using this logic of your free cash flow. So you take your sales, admittedly, that sales can also be presented as your sales less your cost of sales, giving you a gross margin. So they will show this area in different ways. So there may just be a single line number you bring in. It may be a combination of line items. Take away your operating expense, so excluding things like your depreciation, amortization, and through. That will get you your earnings before interest, tax, depreciation, amortization, which they could always just give you that line. Note that you then take away income tax. Either you take away or add your increase or decrease in fixed capital. Now, can I just note, if it's an increase in fixed capital, it's a negative. If it's a decrease in fixed capital, it's a positive. Similar sort of logic coming through with respect to your working capital. We just need to make sure we understand that we watch the phrasing as to how those amounts may be shown to us in an exam environment. The other way, of course, is that they may expect you to pick up on your terminal value. Now, I will just note, this was in the 119 exam. It was done poorly, I would interpret. So I'd make sure as I walk into this exam that I understand that I take my free cash flow in the final period. So N stands for the final period. We multiply that by 1 plus the G, divide it through by the weighted average cost of capital less G. The G in both instances is the growth rate into perpetuity. So somewhere in the facts, they're going to have to tell you what the growth rate into perpetuity is. Now, as we take that table and the formula, you'll then find as you engage with Institute's material, they're very big on then creating this table format across multiple years. So this is what I mean by watching your multi-year implications. So come through, get your free cash flow, then determine what your logic with respect to your terminal value is, add that in. You will add these figures down and total off. So you'll total off to there, put in your discount rate, multiply through to get your PV. Add those across, that will give you your enterprise. So each of those numbers added across will equal your enterprise. Take away any debt, you've got your equity value. Now again, looking at it like that may not mean a lot. So let's have a brief look at that. What you're looking at in this instance is taking the logic of Oz Retail. Considering acquiring Syked, they've told you Syked has sales for the year end 20 June are forecast to be 1,162,500. Sales for the year ended 30 June 19 were 1,107,143. Sales expected to grow at a rate of 5%. Forecast period including the 30 June year end is 4 years. Gross margin of 40% is expected to continue. I've then given you other details about operating expenses, annual sales growth rate of 5%, terminal growth rate. So that's that growth rate into perpetuity is your 2%. Sykes debt is 2.5 million. You've got to assume a WACC of 8% and a tax rate of 30. We can take that all information and we can construct that table. So basically your 1162 was given to you. You then got told you had a sales increase per year. You got told your gross margin was going to continue at 40%. And then we got told our operating expenses starts at our 150, but as you work your way through, expected to increase at a rate of 4% per annum. So 150, 156, 162 and through. That gets you a profit before tax, which you then need to accommodate your income tax paid, which is quite simply your 315, take away your depreciation. So just as you work through here, did you note they told you that depreciation per year is 30? So if I take 315 less the 30,000, that gets me 285. 285 by the tax rate gets me 85,500 and would get, that is basically how you'd calculate across each of the years. What you're then looking at, however, is your increase in fixed and working capital. Well, Let me just highlight. Over the screenshot, I've got how I've done the income tax calc, so that base logic. But note, all I'm doing with respect to the increase in fixed and working capital is that the issue will generally express this in the context of what's happening with your sales. So what you'll note is that they've told you that sales growth rate of 5% and fixed capital and working capital forecast to be 25% of the increase in sales. So all you do is work out your increase in sales each year. So we got given the 2019 figure, we had to determine the difference between the 2019 and the 2020 of 55357. We got given 25% as our rate, so 25% of 55 is 13839. 25% of 58 is our 14531, so on and so forth. So we just drop those numbers in. Now, as you can see, when they were doing the 12 and 14 markers, it was of this sort of size. The last one, which was the 6 to 8 mark, it was smaller than this. They didn't have all of these line items in play. But you'll then find as I've worked my way through, I've done that for each line item. I've then had to calculate my terminal value. My terminal value, I need to take my last figure, my 251675, and I need to multiply that through by 1 plus the growth rate, and then I divide it through by the 8% less the 2%, so less the growth rate. That gets me 4278. Take that 4278, add it back into the equation. All I'm therefore doing is adding these through. Then I'm applying my discount rate. I add each of these numbers through, and they'll equal my 39. So if all you've been asked for is the enterprise value, you'd leave it there. If I'm asking you for the equity value, however, I've needed that debt figure for psyched, so I take away my 2.5 and I get an equity value of 1.4. So again, just an appreciation of the depth that they can get to in this area. But I would argue these are very mechanical. If you can spend some time just working your way through the construction of one or two of these questions, and any of those questions previously, whether it be the coverage coming through with respect to your 317, your 218, would be good base questions to use in this area. The other side to that, however, is the determination of your market-based valuation. And you'll find that activity 13.1, 13.2, and worked example 13.2 all have market-based valuation requirements. Basically, what you're doing is applying a valuation multiplier to earnings. We have seen a 7 mark and a 3 mark. Probably a little bit of time since we've seen this area, so if they want to come back here, that may be a reason why they would come back here to see if you can do the market-based. But basically what you do is with your equity value, you take your underlying profit figure, multiply it through by a price earnings ratio. Enterprise value, you take the underlying profit figure that they represent and multiply that through by your EV on EBITDA ratio. You need to use ratios for a company of similar size and activity. And if there is no single company of a similar size and activity, then you may need to calculate an average to that degree. But again, if I just highlight that as you work your way through the formulas, quite simply, equity, you take an appropriate measure of equity, multiply it through by your comparable price earnings. Enterprise, take an appropriate measure of your EBITDA and you multiply it through by a comparable EV on EBITDA. So these are simple calculations, provided you understand what they've asked for and what variables you are drawing to. So with respect to an equity value, Brakes Limited is an unlisted entity that is looking at investing in Morris. Profit after tax from Morris has been identified at 7.5 million. A quoted company similar in size and activity to Morris has a price earnings ratio of 8. Calculate the equity value, take your 7.5 million by your 8, your equity value is your 60. If you're only acquiring 30% of them, you take 30% of that figure. From an enterprise value perspective, Jurassic unlisted entities is looking to investing in Tyson. EBITDA for Tyson has been identified at 5.2. The EV on EBITDA for a company similar in size and activity has been identified as 4. Calculate the enterprise value. 5.2 by the 4 gets you a 20,800,000. If you're not taking 100%, taking 50%, you take 50% of that number. So, and this is why I don't think this area is being attractive for the institute in an exam. If you understand the little components to the formula, and provide you can read the information correctly, you should be able to generate marks fairly quickly in this area. I did, however, note that you've got to use a comparable company. So if you go back and look at those prior questions, you'll find in one of them, you didn't have a comparable company, so you had to come up with an average. So the way you do this is that I've got healthcare, a small listed company in the healthcare industry, owning private hospitals and healthcare centres. Healthcare are looking to acquire a medical centre on the New South Wales North Coast. There is no company of similar size and activity, but you've identified 3 comparable companies, or 3 other companies, I should say, in the healthcare industry: Rocket, Care Health, and Bippo, each having EV on EBITDA ratios of 5.2, 6.6, and 5.6. In that instance, the EV on EBITDA ratio that would be applied as your multiplier would be a average. So add those 3 numbers together, divide by 3, and you've got your ratio of your 5.8. So as I said, a relatively straightforward area if you know the components to the formula. The other thing the Institute have been doing, however, is looking at it from an other impact perspective. So certainly if you pay attention to, I've got noted here Management 315. I'd also note Management 317. Should have been another one I had on this screenshot. Question 4 Part B gives you a 8 mark other impact question. Now, I would argue if candidates have got to the back end of this unit and read through, well, if you're looking at valuing smaller businesses, investors demand a premium return to compensate. That would be a factor taken. Controlling, non-controlling. If you take a controlling interest, the Institute says you should pay a premium. Non-controlling, they say that you should have a discount to the figure you've determined in the range of 20 to 30%. They make the point that if you are looking at valuing a quoted company, you'll find that its value is taken usually to be worth more than a value of a non-quoted because you've got a ready market for the sale of your shares. If you go to a unlisted, a non-quoted, that is not as available to you. But again, note how Unit 13 has that possibility of being the logic coming through with respect to calculation based, but also can do areas such as this other impacts from a qualitative perspective. From there, of course, if you're going to look to acquire, you may need to fund that acquisition. And you'll find the final 2 units of coverage that you've got are your coverage of 14 and 15, where you're looking at Unit 14, short and medium term finance. Unit 15, you're looking at your long-term finance. Now, just note with respect to Unit 14, basically they do a little bit of introductory coverage around your overall financial strategy of cost versus risk, aggressive versus conservative. They make the point that for short term, you should typically be thinking 1 year or less, and they make the representation that there are both financial and non-financial sources. And then medium term, they're talking 1 to 5 years, which is where they show you areas such as the leasing. If we just build across these, with respect to that aggressive conservative logic, maybe just one thing to pick up on is that if you've got an aggressive logic, you'll find that short-term funding may be used to fund both fluctuating and permanent current assets. You'll find if you're conservative, very little, if any, short-term financing is used. All assets are funded by the long-term sources. Basically, the strategy adopted will be dependent upon your risk profile. And again, the reason I'm highlighting this is that if they walk you in and go, how would you fund this? And they say that they're conservative, then they're going to expect to see very little in the short-term financing area. It'd be more so that medium to long that they'd be looking for. If I come back to the short-term, however, I've already noted non-financial and financial. You'll find that we saw a smaller applicability question in 218. You'll find that, and again, guys, that was about 2 to 4 marks from memory. You'll find that with respect to 313, we saw having to provide 2 practical sources of short-term financing, and you could go from either the non-financial or the financial. So one thing I might watch in this exam, if they give you a short-term, just watch the phrasing. Have they asked you for non-financial short-term? Have they asked you for financial? Are they quite like 313, which would allow you to do either? From a non-financial perspective, trust you understand that relates to areas such as your trade credit, your extended payment terms, consignment stock, accrued wages and taxes. I tend to find candidates are more than comfortable around things such as your trade credit and your payment discounts and through your extended payment terms. What they tend to get a little bit lost on is what the Institute means by the accrued wages and taxes. Basically what we're talking about here is that if you think your employer, if they pay you halfway through the month, then for that first 2 weeks of the month, they've got access to your wage to fund their operations. Probably more importantly, however, is that they will need to retain from your wage some PAYG. So during the period that they have retained that from you and not provided it to the tax office, that is providing them with a source of finance. Now, that's where some organisations will get themselves into trouble. They will retain those funds and then use them, not having them to pay. But that's basically what the Institute's meaning with the accrued wages and tax area. You'll note, however, through here that I have reference to the discounted and the extended payment terms. Maybe just pick up on discounts. You'll find that suppliers who offer credit terms may encourage early payments with discounts. So therefore, under worked example 14.1, you should engage with your nominal and effective interest rate formulas, noting that you will take the discount. So the logic is you will take the discount if the overdraft rate that you have is less than your effective interest rate. So don't you take the discount if the overdraft is less than your effective interest rate. If you're looking at it from an extended payment terms, basically you're looking to negotiate extended terms, the supplier may in that instance hit you with a fixed percentage premium. Again, you've got to engage with your effective interest rate formula, and in this instance, if your effective interest rate is less than the overdraft, then you would take on the extended payment terms. Now that's well illustrated in your worked example 14.1. We've only really seen that tested for 3 marks with respect to the 113 exam. The key, however, is that you understand how to arrive at this effective interest rate logic. So you'll find that they take you through a nominal interest rate formula initially, take your percentage discount, divide it through by 100 minus the percentage discount by 100%. You'll then find that you take that and take it into your effective interest rate. So that amount you've calculated then gets dropped into your effective interest rate, and it's 1 plus your I, so that effective interest, that nominal interest rate to the power of 365 on the N. Just make sure you understand how the N is calculated, and basically it's the difference in, if you normally pay in 30 and you're going to pay in 7, the difference is 23. If you normally pay in 25 and you're going to pay in 35, the difference would be 10. So if I show you that by way of example, I've got Brax purchase product from Howard on 30-day terms to improve their own cash position. Howard has offered a 2% discount to Brax if they settle within 10 days. Calculate the effective interest rate of the 2% discount. So you apply your nominal. So 2 over 100 minus 2 by 100% gets you 2.04. Note how then as I'm doing my effective interest rate, I'm dropping that into the calculation. 1 plus 0.0204 to the power of 365 on 20. Now the 20 is the difference between the 30 and the 10. So 1.4456 less 1 gets you 44.56%. So that is how you'd go through that process. Similar logic if you're going to do it for extended payment terms. We normally pay on 30 days to improve our cash position. We've negotiated extended payment terms on a premium of 1%. Calculate the effective interest rate in this case. You just take the 1%, so that's it going in there. Note I'm going from 30 to 45, so I'm 15. So the effective interest rate in that instance is 27.4%. Now keep in mind, as you duck back to my logic, I stated that you would only take that on if the effective interest rate is less than your overdraft. So basically what you're looking for in this instance, you would need the 27.4 to be less than your overdraft to take that on. If your overdraft is the average overdraft at around 16%, then you would not take that on in that instance. But again, a couple of areas to be aware of. We then extend it from there across to our financial. Now, I'd like to think without requiring explanation, you understand bank overdrafts and credit cards. You may just need to do a little bit of a touch up with respect to your debt factoring and your invoice discounting. So debt factoring, just make sure you understand the cost benefit. Invoice discounting, ensure you can distinguish it from debt factoring. So I've got a little summary where I highlight that debt factoring, you basically sell your receivables balance to a finance company. the finance company will collect. Typically, they pay an initial percentage, say around 80%, and then upon collection, depending upon the terms, may pay the remainder less fees and interest. You would, in that instance, consider your cost benefit. You would apply the logic of your worked example 14.2. Invoice discounting, on the other hand. Now, please note, invoice discounting isn't doing an early settlement discount, excuse me. Invoice discounting isn't doing an early settlement. Basically, it's an advance by a finance company. A note, whereas with the factoring, the finance company collects, invoice discounting, you still need to collect. And basically, individual invoices or groups of invoices are pledged to the finance company for an immediate payment of up to about 90%. Upon collection, the total amount is paid to the finance company, and the remaining 10% minus interest and service charges is repaid. So I'd like you to think more about invoice discounting as being advanced logic. The downfall, however, is you still need to collect. At least under debt factoring, you no longer need to collect. I would, however, note for this, one thing that I've always been surprised that they haven't done is look more at worked example 14.2, which is a cost benefit exercise. Now, this is where I look at it from the perspective of with a cost benefit perspective. You've got to look at your financial benefit of your improved cash position. So that can be interest savings on bank overdraft facility, interest income on cash invested, so by entering into factoring, versus the cost or saving provided utilizing. So your reduction of your admin costs, add your reduction in salary and wage, take on whatever administration fee is charged by the factoring company, take away whatever the interest charges are. Now that is basically your worked example 14.2. I would strongly suggest that you have a browse at that. I can't remember it ever being examined, but it is something that I look at as a potential 8-mark question in the exam and would sit quite comfortably from a calculation perspective, but not being a mainframe calculation. From a medium-term perspective, however, you talk about your term loans, leasing, hire purchase. Term loans, you can categorize it as intermediate or long-term, so long-term would drop more into Unit 15. You've got the logic of having to meet loan repayments and that fees may be charged. It was a component, so note my language here, a component of the Management 218. So it was a component of the Management 218, question 3, part A, which was an 8-mark question in total. Excuse me. From a leasing perspective, just make sure you're comfortable with the different types of leases being represented and that you understand the logic of IFRS 16, especially from the lessee perspective. Don't get too caught up on this from the lessor perspective and understand the advantage, and there's a quantitative analysis. Basically, all I mean by the treatment of the leases and lease payments, I would like to think that even if you haven't done your FIN module as yet, you'd book a right of use asset, book a lease liability. If I wanted then to get you to reflect on that, if I asked you, well, how does that affect your current ratio? I'd like to think you remember current ratio is current assets over current liabilities. So your lease liability would add to your current liability, therefore worsening your current ratio. So you might see it in that sort of form. Of course, if you're going to book a right of use asset, you're going to have depreciation. If you're going to book a lease liability, you're going to have interest expense. So there is extension work to that. And don't get me wrong, I'm not trying to say there for the minute that you're going to be doing journal entries or anything for release. I think it's going to be, can you identify what the implications are on the financial statements, because it will have a profit effect. It will have a current ratio effect. That sort of logic is what I'm looking for. Hire purchase, make sure you understand in terms of contrasting it to the lease. The idea becomes that you will absolutely take ownership. The advantage of leasing is that you don't have to take ownership. So if you're looking at technology, so come back. My understanding is that when Woolworths South Africa bought David Jones, they were surprised by the age of the point of sale system. I also understand, however, that David Jones had acquired outright the point of sale system, so hadn't wanted to upgrade it because they were trying to get their full value out of it, probably diminishing the customer experience slightly, but that was one of the points of logic. I would also note, however, with respect to that treatment for the lessee, as I noted, IFRS 16, record your lease asset and lease liability. The lease asset is depreciated depreciated over time, with lease payments allocated between your interest expense and liability reduction. Note there is a recognition exemption here, however, for what we refer to as low value assets, short-term lease, so something less than $5,000 US, short-term lease, something less than 12 months. In that case, under IFRS 16, the lease payments would purely be expense. But I also suggested there's a potential quantitative analysis that the Institute could do in this area. Now, this is where they show you activity 14.1. We've seen this for 7 marks in Management 115. And again, guys, not a regularly examined area, but if I walk you into one of these for 7 marks and you've done activity 14.1, it's just going to be huge substituting in your numbers into their scenario. And that's where I like Candace to make sure they've got all this sort of stuff covered off. It's not regularly examined, but you don't want to be the exam where they do it and then you're going, well, I'm just sacrificing those 7 marks. So you need to compare the present value of your leasing to your present value of the borrow to buy. Basically, if your present value to lease is greater than your present value of borrow to buy, you would lease. If you've got negative NPV, that means your present value of borrow to buy is greater than your present value to lease, and you would look to buy in that instance. So note our paths that we can follow. Again, worksheet represented. If you work your way through here, you'll find that the investment cost not incurred will be year 0. You'll find that in terms of your lease payments, your tax benefits, they are likely to work through your year 0, year 1, year 2, depending upon whether payments are in advance or in arrears. Salvage value foregone will come over in this final period. You'll then have a tax benefit foregone on the salvage value. Pick up on your net benefits. Apply your discount rate again. Get your discounted cash flows and get an NPV. Is this a positive or negative NPV? That will determine which path you are following in terms of your decision. If it's positive, present value of leasing is greater than your present value of borrowing to buy, so you would lease. So let me illustrate that in brief if I can. Again, utilising the activity as a base. I've got Brax decide to purchase plant and equipment to aid their production process to meet anticipated growth. New equipment costs $900,000, expected to be utilised for 3 years. Plant is subject to 25% tax depreciation. Expect to have a salvage value of $100,000. In terms of buying, Brass can draw down an existing bank loan facility which has an after-tax cost of 10%. Alternatively, the plant can be leased over 3 years with lease payments of $345 due at the start of each year. Assuming a tax rate of 30%, determine whether to lease or to buy the plant. In that instance, note my 900 goes in the first year. 345, we've told you that 345 is due at the start of each year. So therefore, I've got it coming through in year 0, 1, and 2. My tax benefit is quite simply the 30%. Sorry, come back. We've told you the tax rate is 30%. So the 30% of the 345. The tax benefit foregone on the depreciation. So note it's $900,000 over 4 years. So $900,000 over 4 years gets you $225 per year. $225 per year at 30% is your $67,500. My salvage value foregone I got given as 100. I then need to calculate my tax benefit foregone on the salvage value. So I take my 900, take away my 675, come to a figure of 225. Salvage value foregone is 100, which leaves me at 125. That 125, I take 30% each year, and I get 37.5. Add those down, do my discount rate. Got negative NPV, negative NPV. Therefore, that tells me that I borrow to buy. So, and this is what I mean, guys. A lot of these, you're not seeing them a lot in the exam, but if you know how the numbers are constructed, you should be able to generate marks as you work through the exam environment. So just make sure if you can get your hands on that question that I noted with respect to 115, test yourself against that question for me. As we then come through, however, that leaves us with our final unit, which is our long-term finance area. I may just go a little bit past the hour here just to cover this off, but just note, you've got types and sources, your capital structure, and your dividend policy. So the types or sources are your types of equity, types of debt, types of hybrids. Capital structure, they talk about your optimal and your Fricto framework. And then with your dividend policy, you're looking at it from the logic of what is the dividend policy in practice for the organisation. So with respect to your types and sources, note sources, they talk about equity and debt. So source of equity, source of debt, that sort of logic. Worked example 15.1 does a comparison look. So it compares different types, different sources of equity and debt. So that's not a bad process to work your way through. But then you'll find they then talk about types of equity, types of debt. So types of equity, shares, retained earnings, and raising equity capital. I'm probably more of the view that it'll be raising equity capital here if at all. So yes, we understand shares can be ordinary in preference. We understand that if we don't pay out dividends, we retain funds. If we retain funds, we retain earnings. They can be used as investment into the entities, for growth of the entity. Where I'm going to highlight, however, if the institute comes here, it tends to be that raising equity. Are they talking private or public? Private, they're looking at it with respect to family and friends, angel investors, crowdsource. You'll find that that 218 was an 8-mark combo question where you had to look at different options and determine their appropriateness. Of that listing, however, the one I'd make sure that I'm really comfortable with is the private equity through venture capital firms, and make sure that we understand the institute's logic is that that is basically a high risk, high return. So my simple example is Anchorage Capital, when they brought or purchased, I should say, Dick Smith from Australian Woolworths. They paid 90 million. Now I appreciate there's a couple of issues that went wrong there, but they paid 90 million and listed it after 12 months for 450 million. That's that high risk, high return. We're going to invest. We're then going to get our money out of the entity through that IPO type process that they went to, which in turn is where you consider public. This is where you do IPOs and seasoned equity offerings. Make sure you understand an IPO is selling shares to the public for the first time. There are listing rule requirements in play. However, having said that, my experience is that the Institute has never really expected you to have any great knowledge of the listing rules. They just expect you to know that there are tests that have to be met without being able to apply those tests. They also expect you to understand that to undertake an IPO does take significant management time and cost, which is where you get one of the negatives. But of course, the way you ensure that it's successful is to have it underwritten. So advantages, disadvantages for me is something to consider in this area. Advantages, getting ongoing opportunities to raise capital, provides an exit strategy. Disadvantages, you've got your possible change in control, and you've got that continuous disclosure requirement. The other side to your IPO is your seasoned equity offerings. Basically what you're looking at with seasoned equity offerings is that you've got your 4 types. I would just make sure I can identify which to apply in which instance. And I'd also make sure that I can, on the basis of worked example 15.1, identify advantages and disadvantages of each. So the 4 are your rights issue, your placements, your share purchase plan, dividend reinvestment. All I'm going to request, if you're in the exam and having to consider a source of finance from an equity perspective, and it's a listed entity, understand you can't talk IPO. You're going to have to talk about it in one of these forms. So you're going to have to talk about a rights issue. So for every 8 shares someone has, they can buy one, purchase another share at a discount. A placement is where you go to selected shareholders. So you would go to selected shareholders and you look to offer them additional shares in the company. Advantage is that no prospectus is required. However, you can only do up to about 15% of the entity or 15% of the share capital through that. So if you've got $10 million worth of shares, you can't do more than 1.5 million via a placement. Got your share purchase plan, both Australia and New Zealand, maximum of 15,000. So maximum 15,000 in any one period. So any rolling 12-month period from the one shareholder. So if I'm looking at a share purchase plan, I'm probably just noting how many shareholders do I have. Multiply that by 15. Does that allow me to raise the funds? And then your dividend reinvestment, as opposed to paying out cash, they basically take additional shares in the company, so it saves that cash outflow. So if you've got $100 that you're going to pay as a dividend, your shares are $3 each. they would get another 33 shares is how you would think that one through. Of course, as you consider that, just note with the rights issue area, and without us getting too caught up in this in detail, the Institute does show you some formulas with respect to the number of new shares to be issued and the number of shares a shareholder must own, along with a theoretical value of one right, which if they want to do something a little bit left field for 3 to 4 marks, this could be of interest. So my base example, Oz Retail, listed entity holding ownership of several retail brands. They're considering a rights issue to raise 30 million. They currently have 30 million shares issued with a market price of $6 per share. The subscription price on new would be $4. Applying this to the formulas provided, number of new shares to be issued would be your 30 million by your 4, which would be 7.5 million. Number of shares a shareholder must own would be a 30 million on 7.5, which gets you 4. And then your value of one right, so as I said, it's at a discount to market, would be $1.60. So that is the value. And note, you can trade in the rights. You can sell your right for the $1.60 if you want, and therefore you may sell it for $1.60 and they may purchase the entitlement to the company at whatever the discounted right figure is. So we've got a couple of little calculations through there. Again, but note how, as I'm getting to here, guys, I'm going, this is what they could do, because this really hasn't been looked at. Similarly, you've got your hybrids and your convertibles. Logic coming through with respect to your hybrids and convertibles. Make sure you're comfortable around the reasons for issuing. So sweetener for long-term debt, method of delaying the issuance of ordinary share capital. You got your convertible notes, convertible preference shares. So convertible notes, unsecured instrument that pays the holder a regular coupon payment and a face value at the end of the note term. Provides an option to convert the face value into ordinary shares. Convertible preference shares provides the option to exchange preference shares for equity. Debt characteristics are the instrument pays a regular defined income stream. As you then build, however, there, once you've got that little bit of coverage out of the way, you come across to your long-term debt. Look, yes, you can talk about loans, you can talk about bonds. All the Institute's really interested in here historically is the logic coming through with respect to your loan area. So that idea that you've got a provision of money in exchange for your future repayment of your principal and interest is what you're looking at. As you build that through, however, you'll find that the extension of that then becomes a logic with respect to your determination of the points of interest that you would consider. So you've got advantages and disadvantages, advantages of equity, no requirement to pay annual dividends, debt is cheaper than equity. Disadvantages, equity looks to dilute the owner's interest, and from a debt perspective, it's the possible cash drain. Factors impacting include your organisation size, global economic conditions, your risk profile, and your growth phase. Of course, once you're to there, you'll find that the Institute then extends into the capital structure logic. So you've got the idea of your optimal capital structure and your practical considerations. So your optimal capital structure is the one that minimises your WACC. So that can link you back to your earlier units. They then do some practical considerations with respect to, there's a couple of studies that they reference to in terms of surveys and Graham. They talk about your restructure implications. Again, all nice knowledge, guys, but at the end of the day, these two questions have been 2-mark questions. Not totally convinced that I would get too caught up on. If they're going to come here, I'm a firm believer that they'll go to the FRICTO framework. So make sure with this coverage, you're just comfortable that FRICTO is the acronym for financial flexibility, risk, income, control, timing, and other. So financial flexibility, you retain your cash resources to take advantage of opportunities. So therefore, on that basis, that's why you might look to use equity as a first step. Risk, what is your ability to meet your obligations? Income, it's that ability or the impact on the return to shareholders. Control, increase equity may dilute current ownership interests and change the control structure. Timing, what's more appropriate? So with interest rates low at the moment, it may be more appropriate to use debt if you can access debt. And then other is how quickly are funds required as a base logic. And to that end, if I consider Oz Retail, considering acquisition of Surf Extreme, apply the FRICTO framework in determining. Basically what you're looking at here is that if you're deciding the use of a bank loan for funding, some of the factors that you would consider, what is the current debt position? Increased debt levels lead to increased financial commitments interest and principal repayments, which is your risk area. The increased interest expense would decrease profit, which is your income. What debt covenants exist are your control. What are the current interest rates are your timing. What is the speed with which funding is required? That's your logic coming through with respect to the other. So, and again, that, based on what I'm seeing in Capstone, where they've been hedging around this area now for a while and they're probably not as comfortable as what they would like Candas to be, do not be surprised if that area pulls through. And then in closing, the other path you've got, again, we haven't seen this since 214, is your dividend policy logic. So it's basically establishing the profits to be paid out. Practical considerations would include what are the shareholders' requirements, so why do they hold shares? So go back, Telstra at one stage was a mum and dad company. Lots of mum and dads held shares in Telstra. Mum and dads were holding them for the dividend. Therefore, Telstra kept paying dividends. So therefore, their policy was to pay dividends. You can also look at it from a tax and a conveyor of information. If you're paying dividends, it's meant to illustrate that you've got strong financials. But then you've got a couple of approaches, your constant growth model and your constant payout. Note in turn that was tested in 214 with respect to the logic of your major approaches. And that 214 question from memory was about a 2 to 3 marker. But having said that, what you would have noted through there is 12 and 13 heavily calculation based, 14 and 15. Note how few questions I could reference to. Now that's got to change at some stage, and certainly I like the 218 where there was the 8 mark question. I think that's probably going to be more the norm as we move forward, but I'd certainly suggest the Fricto is something that we may want to consider. But at that stage of the night, that was the process and the logic that I wanted to get through this evening. I will call the session at that time. I'll stay on the line and answer any individual questions you may have. I trust that I will be starting tomorrow the management one-day session, so I trust I'll catch up with you at those sessions. But at that stage, if you've got questions moving forward, just make sure you're asking me at techhelp@plsaustralia.com.au. Thank you for your attendance. Trust you've got some value out of that, and we'll look forward to catch up in the future. Thanks, everyone. If you've got questions, feel free to stay on. Otherwise, we'll catch up over the course of the next week at the one-day courses. Guys, if there's no questions, I'll call it there. Thanks, everyone.